Hi there, I got a new investment idea from a viewer. If I can analyze CCI or Crown Castle, as they are paying a dividend around 5.7%, which is expected to grow even more in the future, and the stock price down over 40%, I said maybe there is some value here. So you'll find out the outlook of this business and at the end the fair value of Crown Castle, whether it's a good buy at the current price. Let's begin. Maybe you know that Crown Castle is a REIT. They make money from renting their locations. And the most important indicator is funds from operations. Based on these numbers, you can value this business to see if it's overvalued or undervalued. As you can see, they made 3.2 billion last year, and the funds are expected to increase a little over the next 5 years, from 3.2 billion to over 3.5 billion. Be aware that these are the analyst estimates. They expect higher interest rates. But if rates go lower, then this number may be higher. Moreover, their dividends are also expected to increase from $5.97 to over $7 by 2027. That will be a dividend about 7% at the current price. So for dividend investors, this might be a good investment. But don't rush, there are other things you should know. In this image you can see that they expect a growth rate of about 4% for 2023. Their funds from operations to be around 3.3 billion. This estimate is from management. And they said that they continue to benefit from the growth in the development of 5G. They have about 40,000 towers, small cell developments across 85,000 route miles of fiber, which will help them to deliver compelling returns through a combination of dividends and growth. They had an increase in their dividend of 6.5% compared to the same period, and they expect positive trends across their business, but they'll be affected from higher interest rates. As a result, they expect dividend growth in 2024 and 2025 to be less than their 7% to 8% target. But in the long term, they expect 7 to 8% growth rate in their dividend. Plus, another good thing about this business is that they have great tenants. Companies such as T-Mobile, AT&T, Verizon, and others. As you can see, they represent a big part of the revenue. They have about 400 million in cash and 22 billion in debt. Now, don't get scared. About 88% of their debt has a fixed rate. So if rates go too high in the short term, they won't be very affected, only if the rates continue to be high for a longer period. Now, there is a problem you should be aware of, which is dilution. As you can see in this image, they increased the number of shares from almost 300 million to over 400 million in the last 10 years. And if they continue in this way, then your value will decrease over time, even though they are paying a nice dividend, which is expected to grow even more. For instance, if they pay 1 billion dividends and only 10 people own this stock, then that amount will be divided by 10. But if they issue more shares, let's say to another 10 people, then that dividend won't be divided by 10, but by 20, as there are more owners. So you have to be aware of this risk, which is dilution. And of course, higher interest rates, if they continue to be high for a longer period. Now, let's see the valuation. First, the risk. For a 10% annual return, the fair value may be around 29 billion. Or if you want the fair value per share, that would be $65. So compare that to the stock price, which is $109. The stock price is quite overvalued for a 10% annual return. This is the risk. If they issue more shares and interest rates go up, then this scenario may happen. That's why you have to be aware of the risk. Now let's see the gray scenario, where the fair value may be around 44 billion for a 10% annual return. If rates decline and they grow their business a little, then you can expect this scenario. So the current level, the stock price seems fairly valued for a 10% annual return. Based on this scenario, if everything goes well, growth ahead and lower interest rates. In the normal case, the fair value may be around 43 billion for a 10% annual return, or $77 per share. This may happen if rates stay high for a longer period, then their growth rate may be affected, because most of their funds will be used to pay the dividend, and they won't have enough money to fund future growth. And they have to take on more debt, and as interest rates are higher, they will pay more. That means higher expenses, which can affect their funds from operations. That's why you have to be aware of this scenario. So it's up to you. If you like the risk you have, possible dilution, and higher interest rates, and of course, the reward, which you might get a 10% annual return if everything goes well. But don't forget, always invest with a margin of safety, because bad things always happen. You can't avoid them. And if you have other questions, or if you want me to analyze something new, please let me know in the comments.